All right. So thank you guys for joining today. Again, getting back to the same cadence that we were on before. So we had a meeting last night. So it was quick, but it happened. And so again, normal cadence next week, Wednesday nights, 8 p.m. Central. And that is more of a come as you are, ask as many questions as you want. Today, we're going to talk about a few things. So, first and foremost, we're going to talk about retirement planning in essence, how to kind of handle that conversation, why it's so important, and then ultimately understanding that you have people at your fingertips that can help with these is the most important part. So, just know that you're not doing it alone. A lot of people don't realize that with just a life license, you can offer 401Ks, traditional 401Ks. Again, nothing more than a life license is needed. You can offer defined benefit plans, pension plans, profit sharing, safe harbor, Roths, regular IRAs. So you can offer a various amount of opportunities. And why is that so important? If we actually look first and foremost at the current landscape, you'll see one of the biggest concerns we have here is the average retirement balance is 134,000. Okay. On top of that, when you think about the opportunity here, 36 million small business owners in the United States. That is a ton of opportunity. When you talk about business owners, and I'm counting several business owners on this call. So if you are a independent producer, guess what? You're also a business owner. So these are things that you could potentially do for yourself to plan for your own retirement. Most people have a lot of barriers in the way for planning for their retirement. So, lack of education, cost. A lot of people think that these costs are so high, complex, and then administration is a huge one. A lot of people want it as easy as possible. But most importantly here, 60% are not confident in their retirement. If you talk to any business owner, what is a business owner's exit strategy? Their business. So there's a big problem there because if they stop working, what happens? If they want to exit due to willingly or unwillingly, what happens? What is the design and setup for their overall plan? So if you think just real quick, a recap of how 401ks work, they are defined contribution. And I think that's a big thing. When people think about this, contribution is the key word here. Defined benefit. There is a benefit that's already set. It's like guaranteed. It's tried and true. This involves a lot of opportunity. So once again, going back to education, not a lot of people realize what you can and can't do with 401ks. So once again, the employer does sponsor it, but it is client or employee who controls what they put into it. And a lot of people worry when you put more into this retirement fund, there's less fund money, disposable income, things like that. So a lot of people are hesitant to just put their money actually into a retirement plan. When you think about it, you between 0 to 50 can put in almost 25 grand. Over 50, you can top off on another $8,000, or 60 to 63, you can do the super catch up and add another 11,250 on top of the 24.5. So there's a lot of opportunity from the employee perspective on what they can put away for retirement. And when you look at these mutual funds, you have several different assets you can put them in. Target date funds are intriguing because, so I'm 44. If I had a target date fund that was about 20 years from now, I'd be 64. So what they do is they take a fund that is aggressive to start, and as I get closer to that target date, you want to protect that money. So they switch it more to a conservative type of return so you preserve that asset over time. So those are available in 401Ks and can be very beneficial for those who don't know what they're doing to just put it into a target date fund and let it do its thing. So why does this matter? Or why do 401Ks still matter? A lot of us have been in organizations where they say, oh, don't put any money into 401Ks because you're going to get taxed later on it. Well, if you think of how the tax strategies work, and when you get into retirement, your first, 10% is like, I think 40,000 or something like that. So it's not you're automatically at the top tax bracket. For you to be at the top tax bracket in your retirement, you need to be pulling out over 300 or $400,000 if you're married filing jointly. So there is still a major benefit. And matter of fact, it is still deemed the number one retirement vehicle in the United States with $9.3 trillion currently in 401Ks. So obviously that's a big number. A lot of people are dependent on these, as millions of workers are relying on 401Ks. And really the employers want simple, cost efficient, and most importantly, retain employees. But the employees want tax advantages. They want to feel loved. An employer match might be nice, benefits. And like I said, with that set it and forget it kind of target funding, gives them a benefit of, set it and forget it, so to speak. There's still going to be ups and downs. Don't get me wrong. The story of the IUL, where you have no loss due to market performance, holds true. Whole life the same, guaranteed growth. But you can't throw all your money into life insurance because what's going to happen is you're going to have a lot of unhappy people later. You need some way to hedge against inflation and grow with the market, and that's what these type of vehicles do. And most small business owners haven't had these conversations with anyone because they feel these are meant for big corporations. We can do solo 401Ks. Now, the word solo 401K can be deceiving because solo 401K can be a spouse who runs the business, the person who runs the business and their spouse, I should say. So you can each do a solo 401K for your benefit. So going back to, this slide, that is two people able to put in 24/5 apiece. Now, if you have business owners, you're not the only owner. You can't do a solo 401K because there's multiple owners, but you can do a traditional 401K. You can do a 401K with a safe harbor plan, and other options and opportunities. So, some of the pros we look at for the employees, again, tax deferred or tax free growth. They're getting money put in from their paycheck, void of taxes. So it allows the opportunity for it to grow. And, if you have an employer match, that could be an instant return. So it's automatic, so you don't see it through payroll deduction. And it's probably the last thing a creditor will attack when you talk about creditors, coming for your assets. And it's easy participation. You just sign up, enroll, and pick your funds, and you're on your way. On the employer side, they are looking for attractive benefits for recruiting and retention. The biggest concern a lot of people have nowadays is someone down the street will offer the same employee, $100 more a month, and all of a sudden they're just going to walk down the street because it's a more competitive environment. So, how do you attract and retain people? This is the type of plan you can do. There are tax deductions for employer contributions. So if you're unaware of the Secure Act 2.0, they are giving employers a $5,000 credit to basically set up retirement plans. So if you don't have a plan now, and let's say the annual fee is $5,000. Well, the government is going to give you a straight line deduction, not a deduction per se. I should say a straight line credit. So it's an actual dollar for dollar reduction of your taxes versus if you're in the 40% tax bracket, 40% of 5,000. That's not the case for this type of setup. Scalable for all companies. It's automatic, so when people come in, you can enroll. Safe Harbor does reduce compliance risks. These are all ERISA plans. They are monitored. They have to be going through a third-party administrator to make sure they still meet the checks and balances. But you as an employer can also utilize a vesting schedule. So if we look at the idea over here where it says employer match, that's exciting for the employee. But if you want to protect or use kind of a handcuff for your employee, you can actually use the vesting schedule to keep them on board. So it can be 3 years, 4 years, 5 years. So there's definitely an opportunity from that standpoint to keep them in your wheelhouse. So some of the cons, as we know, limited investment options. So unlike the open market, say a traditional IRA, you can invest in crypto, real estate, whatever you want, ETFs, mutual funds. Inside of these type of funds, there's typically only, mutual funds and target date funds, things like that. So there is a minimal amount of investment options gathered, inside of this. There's still probably about like 25 to 30. Market risk. So as we all know, there are no guarantees in this, but as we've talked before about the buckets, there's the tax now, tax later, and tax never. To fill up just one bucket and negate the other two, in my opinion, can be negligence. So we want to make sure that we're providing a robust portfolio or retirement strategy for the customer. And so, future taxes and RMDs, that's going to be a concern. There are fees inside of these plans ranging between 1 to 3% per year, depending on the funds and the admin fees. And there's no built-in death benefit or long-term care. Typically, there's a little something that we can talk about at a later point called a 401H, which can integrate long-term care into a 401k plan. But that's a different story for a different day. Employers, you have the ERISA concern. So once again, that means there's a fiduciary liability. There's also a third-party administrator who has to do checks and balances. So administrative burdens, compliance testing, and the cost of the match can get up there depending on what you do to provide for your employees. But I think the big reason here why you should promote it is because when you do promote it, you're not competing against it. Okay? Same thing why in this world there are organizations who really love IUL. There are organizations who really love whole life. I love the customer being protected. Okay? So I don't care which side of the fence you're on. You could buy term. The most important part is when you have coverage in force, when you pass away, to protect your loved ones. Same thing here. If someone is trying to put more money into a 401k because they have a high tax bracket and they're trying to reduce that, to say to them, you shouldn't put money into a 401k, you should put it all into an IUL. Now you're not thinking objectively because if you can sell the 401k too, now you can also sell an IUL to complement the two. Okay? One is tax later, one is tax never, and depending on which you want to take from during your retirement, depending on returns, you can adjust the buckets or you know, figure out what one makes more sense for you at that time. The big reason why it's so important for us as life agents, you have a unique skill set that most financial advisors don't think of. Most financial advisors care mostly about assets under management. I know I'm kind of siloing, and I know it's not entirely the case, but a lot of times it's how can I keep assets under management? So when you think about tax diversification, we have that with our life insurance products. Income planning, we can do that with annuities too. Legacy planning, nothing better than life insurance for legacy planning. So when you think about a total holistic plan, you can you can do that. And I'll throw a question out there if anyone is so bold to answer. Um, when you talk about competitor proofing your practice, multiple tickets or multiple products often lead to stickier business. So if you have one product, you have, I think like a 70-75% retention. Two products, you're at about 80-85. Can anyone tell me what happens when you sell a customer three products? How much retention you have on that client? No one. Oh, two people. Tia, you're about to say it, and then you went
I was
back.
I was just gonna guess
That's
a
fine. That's
good
better than dead air.
let's guess. I'll say 95%. I don't know.
So close.
100? 98.
98%.
Ah,
Yep.
got it.
So when you think about it, if you provide someone with protection while they're working, retirement, and legacy, or there are other options like health. There's critical illness policies, so you can sell a separate standalone critical illness policy that some people would prefer because it has an actual number as opposed to a nebulous ABR. So there are different ways that you can do this to, again, increase that retention, loyalty, if you will. And it's kind of like getting a bank account and setting it up, with four different, bills. All of a sudden, it's hard to break free from that bank. So that's the big thing. So holistic planning is the better way to go. And when you think about it, if you are talking about this type of planning, you're now in the big person conversations. You're at the table with them, with the business owners talking about executive benefits, health, life, retirement, all of that is at the table now because you're with the business owners. So you have their planning strategies, supplemental additional retirement, and most importantly, exit planning. Because what do we always talk about with 401Ks after someone is separated from service? Right?
Annuities.
Annuities. So that's why I say, like, it's a total package. So if someone leaves, that 401k is now separated from service, Mr. and Mrs. Client. Do you know that even though you're gone, there are still fees attached to that? Would you like to reposition that asset where there are no more fees, have the ability to grow it without downside risk, and we can help you retire better? So it all repositions back. If you think about it holistically speaking, we protect people while they work, help them retire the way they deserve, and then shield money from Uncle Sam during their legacy years. So it's all cyclical. So it's really easy to, I say that, it's really easy to do these type of plans. Really, the most important part is the planning stage. Okay. So, Mr. and Mrs. Client, I'm going to ask you today, I was going to say, did you get enough tax deductions last year? It's always going to be no. I think my CPA got me down to like $3,000, and I still wish I had more deductions, right? So people are always going to be looking for more deductions. So, did you get enough tax deductions? If I could show you a way where you could increase your deductions, help you plan for retirement, and also retain key employees, would you be interested? Who's going to say no? The next step is we get a census. So the census is the most important part, okay? And I will share with you now what every business owner will always say. Well, just give me some round numbers. Give me some figures. Tell me how much is it going to cost? What can I do? That doesn't work for this. We can't have a bunch of Mr. and Mrs. Smiths on a census form. We need actual data to provide to the companies that are going to run these quotes for us because again, they are governed by ERISA, which is a you know, government plan. And if it is incorrect, the business owner has daily penalties for having a non-compliant ERISA-based plan. So we were actually, I want to say three years ago, we were looking at doing a plan for someone, and they said, "Oh, I already have a plan. I have a solo 401k." Well, the guy had four employees as well, and it was in place for over 2 years. The problem with that is that's illegal. And when we uncovered it, we're like, dude, you got to get this fixed ASAP. You're going to owe Uncle Sam a lot of money. And all of a sudden, he stopped talking to us. It was like that ostrich theory, if I just tuck my head in the sand, it'll go away. I don't know what happened, but needless to say, is there are penalties that are daily from Uncle Sam if you do not catch him. Um, so we need serious censuses, censi. I don't know. But it takes 5 to 7 days. We partner with Lincoln. Lincoln will do all of the back office work, and then next is the conversation with the client. Phil, I don't know what to say to this client. That's fine. We have people who do. So, okay, it just goes back to promoting teamwork and opportunity. If I can't do it, we also have people from Lincoln who can help out as well. So, we have sources and resources to handle things like this. Then, once it's completed, we fill out an app and we're on our merry way. So, what I'm going to do is I'm going to show an example of the fee structure just so you see an idea. Um, and this is one that we've been working on. So, with this, you'll have kind of the fee structure that's involved in the setup. So, record keeping always has to have a fee because there's someone doing work on that end. Okay. You'll see here the compensation for you as a producer, 60 basis points. It can be 50. You really don't want to go above that because, again, it will suddenly turn into a much higher cost. And what I always say is if you try and get greedy here, you're gonna, lose the business to a Fidelity or Vanguard or Schwab or something like that. So the idea though is that this is the initial starting point to get you into a much higher echelon conversation. Okay. This is as my buddy Matt would say, the upside down wedding cake. This is the smallest part to then stack on top of it other resources like profit sharing plans, 412(e)(3s. Someone can choose not to do the 401k, but it's the entry point to start the conversation. A lot of people want to learn more about 401ks, costs, and everything, and it's a way for us to get in there. But really, where you're going to see the fruits of the labor is the 412(e)(3s. Again, if it makes sense. So the cool thing about Lincoln with all of this is they will also do all the back end work in regards to setting up the client with their, I think it's right here. So you can see kind of the back office or the landing page for the employees to actually go and check out their returns and everything. So it's all custom, it's all streamlined. Again, holistic financial wellness tool is available called WellPath or Wellness Path. So they have an option for that, some accolades, and then most importantly, when you look at this. when you look at some of the names here, so MFS Securities, you got Vanguard, right? T. Rowe Price, Franklin Templeton, Cap Group or American Funds, Fidelity, BlackRock. So you can see there's a lot of familiar names here in regards to what you can offer. So much here that I'll show you the lineup or a little bit about it. So you'll see a fixed fund. They call it the stable fund. Very static, 2%. You have your bond portfolios. You're required to have at least three to provide some diversification, but you got bonds, a balanced account, some large cap, and it's showing you the 1, 3, 5, and 10 year. So, and since inception, I believe, or it will have since inception if it's not 10 years or more. So you'll see here all the different rate of returns over the time frame. The client will have all of this information at their fingertips, and then they should be able to make an educated decision on how to plan for said retirement. And these are those target date funds. So if I was retiring in 2060, then I would pick this one. And as you can see here, passive aggressive. How funny. Um, so you'll see the returns over the 10-year time frame, pretty solid double-digit returns for the most part. Long story short, it's a pretty good setup. Any questions on this? Nothing. Nothing at all.
I
So
have a question.
what's up?
I have a question. So,
Yeah.
if it's a business owner and they're wanting to provide 401Ks for their employees, are there limits on how much they contribute, or how does that work for the business owner?
So it depends on the type of plan that they get. So if they do just a regular 401k, the most anyone can put in is 24/5 unless they're older. Now, you can add other things like safe harbor plans, profit sharing plans, and in those instances, the employer, um, the profit sharing is just like it sounds, profit sharing. So if there's profit, they can choose to provide. But
Hmm.
really, when you talk about maximizing that, they can do that, from the employer side. So a good example, my accountant was like, "Hey, you need to put money away, so you can put last year 23.5. So my wife and I can each put 23.5 in, and then he was like, you can also put another 40 in a piece, so we can each put in about 73 and some change." Because of the guidelines and the rules between what an employee can put in and what an employer can put in. So you have a
Hmm.
little bit more governance if you have less employees because it is percentage based from that standpoint.
Okay. Okay.
Um, and to
Hey,
answer,
Phil,
yeah,
question. The employer matching, is that optional?
yes,
Okay, I didn't
yes,
know
you
that.
can do employer match. You can choose not to. Um, And like I said earlier, you can do vesting. So if, for example's sake, I want a 5-year vesting schedule, so I only get 20%, 40, 60, 80, 100% in year five. So that to me says my match will at least provide some loyalty for the next 5 years. If they bail, I get that money going back to me as the business owner versus that. So that's where the vesting schedule comes in to protect against the match.
Okay. That was gonna be my next question, the vesting schedule.
Yep. Yep. So,
Thanks.
oh, no problem. Give them something, you get something in return. So again, um, we don't want to say that we're biased to the business owners, but let's be honest, the business owners are the ones who have the majority of the money anyway. So why would we not be taking advantage of talking with them to then have them look like the hero to their employees, right? So that's the most important part. is how do we move the needle from that standpoint? Um, so that's kind of the initial topic or conversation to bring up to them. Again, it is you know, not the major moneymaker per se, but to kind of share with you too, I believe I have it set up here. I do not. One sec. Can stare at my family. Almost found it. Sorry. I should have had this ready. Shame. Shame on me. I'll touch on a few things here. This is Lafayette, who we use for our 412(v)(3) plans or also pension. It's utilizing life insurance and annuities inside to help people get to their retirement. So when you think about how these plans are set up, is anyone familiar with how pensions work? Anyone familiar with how annuities work?
Yes.
Yeah. Go ahead, Rick. Tell me.
It's what the employer puts the defined benefits each year, what they're going to put in,
Mhm.
basically, for the employee.
Yep. So there's a defined benefit at the end of the road, right? So the max amount you can receive at 65 from a defined benefit plan.
3 million.
Well, it depends on how old you are. The annual limit as of this year is $290,000 per year. Okay. So what does that mean? You have someone who is 40 and you have someone who is 55. What does that mean? If the max I can get to per year guaranteed with a pension is 300,000, we'll use easy numbers, 300,000. Well, if I'm 55, oops, well, we'll do it here too. If I'm 55, my horizon to 65 is short compared to someone who's 40 with their horizon to get to 65. So, in order for me to get that $300,000 per year, I need a bucket of, let's say, depending on age, between $3 to $5 million in my retirement account to give me guaranteed income for the rest of my life. So these defined benefit plans are very beneficial for someone who is over 50 and may have employees who are in the younger bracket. Okay. So it allows them to get higher deductions and not so much because you still have to provide for the other people in the plan. You just carve out or don't give them as much as the business owner. So you have the ability to do that too. So does that part make sense in regards to everyone has the same number at the end of the road? Okay. So depending on how long it takes you to get there, now some people will try and do different investment vehicles because they're more interested in rate of return. This is not a rate of return conversation. This is long-term deductions with a fixed number at the end of the road. So if I'm 55 and my goal is to get to 65 with $3 million at the end of the road, I have 10 years to go. I didn't even count if that's 10 or not. 3, 9, 10. Anyway, so let's say for example's sake, I use a fixed solution, let's say whole life and a fixed annuity. and the goal is to get to 3 million by the end. Well, I have 10 years of deductions to reduce my taxes every single year to get to this 3 million. Now, the other side of the coin would be someone who's a business owner is always thinking money, grow money, must make money double, and all the other stuff, right? Well, let's say we did an IUL, because you can technically do IULs and defined benefit plans. Well, let's say you juice it up so much that it hits $3 million dollars right here halfway through. You don't get deductions all the way to the rest. So you're still ending at the same number. You might get there quicker, but now you lose out on the deductions that you would get throughout the rest of your working years. So this should never be a rate of return conversation. This should always be about deductions because the end of the road is going to be the same no matter what. You just have to either stop putting more money into it if your funds are too good and now you lose deductions, or let's say the IUL doesn't perform. Now you have to put money into it above and beyond what you're planning on putting into it. So does that make sense? Am I getting through here? So there's no bad products is the biggest thing that I would say here. You can do IUL. You can do fixed index annuities. You can do whole life. You can do fixed annuities. Fact of the matter is this is not a rate of return conversation. This is a deduction conversation.
Yeah, when you overfund, Phil, there's also excise taxes and a whole other mess of stuff you're getting into. So you always want the fixed rate of return on these.
Absolutely. And if you think about it this way too, so I look at a gas tank, okay? So say you're at the middle here and Uncle Sam says you owe us, $40,000, negative, okay? But in order for you to wipe that $40,000 clean, you have to put in 120,000. Well, that's really a $160,000 swing because you not only eliminated that tax that you were going to give to Uncle Sam, but now you put 120,000 in towards your retirement to work towards you having a better retirement. So people are going to see it differently. Oh, shoot, I have to put all this money over here. That's money out of my pocket. But you have $40,000 that was going to go to Uncle Sam and you never get to use it again. So, which one is better? Do you want to plan for your retirement, be proactive, or do you want to give Uncle Sam money so you could have a little more in your pocket and just have it sit there? Questions, right? That's the big thing. So this is not, again, a rate of return convo. It is a tax deduction conversation. Kind of beating the dead horse because, again, repetition is key. And you'll see here again the story about 401Ks. Why are 401Ks still okay? Because, like I was saying before, you're at the 37% tax bracket in retirement. You got a bigger problem. We should be talking about estate planning, $693,000. And by the way, that means you're getting all of these first. So your first 22,000 is 10%. Your next, 80,000 or 60,000 is going to be taxed at 12%. So it's going to take a while to get up there. So to say to someone not getting tax deductions today that are available is negligent because someone has to be really well off for them to be in a much higher tax bracket. Yeah, the tax bracket is probably going to go up, but to this extent, come on, let's call a spade a spade. So that's why I say understanding like actual tax brackets and understanding how to talk about them is very important, especially when you're talking to business owners because they probably know this stuff too. Okay. So, as we talked about it before, contribution versus defined benefit, guaranteed annual income. So, people don't want to mess with the market, Chris. this is an opportunity from that standpoint where you don't have to worry about that. Whereas if you want to balance it, the 401k can be super aggressive because that's not in the calculation. We talked about that $3 million by 65. The 401k is not even in that calculation. That is the defined benefit calculation. It's only by the employer, not the employee. Investment decision risks are on the employer. So again, having tried and true fixed numbers make more sense because it's predictable and the investment decisions and risk, all the onus is on the employer. So if you have something that's volatile, that will come back to potentially bite you in the keister. So that's why I say, like in all of these plan types, we can do. Okay. You can do SEPs, profit sharing, 401k, traditional defined benefit plans, cash balance, 412(e)(3s. We can do all of these with just a life license. Um, we, as you see here, these are old numbers. I'm working with what I got, but you'll see you have limitations. Now, again, the 412(e)(3 gives you the biggest tax deduction possible. Predictability, tax deductibility, and let's say they sell their business, they can carry that with them afterwards. So you have opportunity there to walk away with a retirement plan, even if you sell your business. So even if, like they say, you should have at least 5 years, but if you sell your business, you can dissolve the plan, keep the assets there. That is not part of the selling of the plan or the company, so to speak. That is your plan. Good example here. So once again, you look at the age disparity. Okay, that's the big thing. And there's an 80-20 ownership. They also have 5 full-time employees. And the big thing that is so important is actually getting the different types of names of the employees. Okay, so we can talk about carve out plans. So if you have the actual occupation versus employee one, employee two, employee three, you can actually work on carving out more plans to maximize for the owners and potentially exclude some employees. So here's what they did. So these are several plans and plan options. Again, the salaries are up here. So thinking in line with what these people have, you can do a SEP. The problem with the SEP is you're required to basically fund, I don't want to say equally, but pretty much equally with the contributions to the employees. So not a huge benefit there. Profit sharing looks nice because we're carving out the employees, giving them less, still the same contributions for the employers or owners, I should say. Then we start kind of jumping over to the traditional defined benefit 401k profit sharing. Now you have a higher deductible opportunity, but that also meant a lot more for the employees. Or you could really juice it up. They ended up going with the middle. So they want to carve out people and still get a higher opportunity for the business owners. But these are all types of plans that we can orchestrate and put together for the business owner to make sure that we're taking care of them. They're still providing a value to their employees because, as you see here, contributions for the owners are very high, but they want to make sure that they can carve it out to save on taxes. Okay. Once again, it's a tax conversation, not a rate of return conversation. Problem with SEPs, again, contribution is deductible up to 25% of total compensation, but you have to do it for everybody. And it's immediately vested. So, Raphael, going back to your question about preservation, preservation there. They can walk away the next day. So you have to watch out for that. Part-time employees must be included. You can exclude part-time employees from the other qualified plans. So a SEP is a very big thing to watch out for in regards to a business that has, say, more than husband, wife, it's like a conglomerate, 5, 10 employees, things like that. So this is a current study, a case study with a SEP owner. 57, spouse 54, two employees. So they want to kind of carve out the contributions. A little worried about fees though. But if you'll see here, um, the current set plan, they have 44,000 going to themselves and 17 going to the employees. Well, if they flipped it over to a profit sharing plan, now all of a sudden they have more money going into their pockets, less going into the employees with an administration fee. So there's no wrong answer. The right answer is the one that the business owner wants to go with. Okay. So this is just giving you additional options and ideas that are available for the business owner to take advantage of. So combining these type of plans, setting up a 401k with a cash balance, defined benefit type of plan allows for a mesh or weave of the opportunities together. So you get the plans tested together. It allows for a bigger benefit and deduction, and it allows the business owner to get more to put away for themselves because most of the time the business owner is going to be older than the employees. And this is kind of what I was talking about. This is the old assumptions. You needed a certain amount by retirement. These are kind of the numbers, just giving you an idea for contribution levels and things that you could actually put. You also have a death benefit that you can get inside of these type of plans. So the older someone is, the more it'll cost them per se, but it has to meet a specific number by the time they get to 65. So it's like a catch up. So integrating life insurance into these type of plans, if for example's sake you did just annuity funding by itself, you have 225,000, monthly benefit of 18,750 at retirement, or you could couple the two and now all of a sudden you have a bigger deduction, 282,000 versus just 225. And the interesting thing about this, so think about people who have a need for life insurance as well. So the cost for this life insurance premium is $135,000. That's pre-tax, if you will, from that standpoint. Now, to get to 135 on a life insurance premium, after tax dollars, if you're at the 40% tax bracket, would cost you 225,000 by itself. So you're now getting a discount on that life insurance because you're putting it towards a retirement plan. Now, some people will say, well, Phil, if I'm getting a deduction off of that, that means there is going to be some type of taxable concern. And the answer is yes. So, in this example, let's say I'm going to use easy numbers because there are options for that life insurance inside the retirement plan. Let's say I have $1 million, and inside of this plan, I have, I'm going to use real easy numbers, okay? I'm going to use 100K as the cash value. So, what can I do with this life insurance policy that's inside of the retirement plan? First one, I can surrender the policy. That doesn't mean I'm taking this 100K and giving it to myself. It means this 100K is going back into the plan. So, say I have $500,000 on the annuity side, this 100,000 is going to be added to it. So you have a big bucket now of 600,000 in taxable benefit that you can take for retirement. Is everyone with me so far on that? Okay. Lump sum distribution. That is me taking it. Okay. That is me taking it to myself. And this goes away. I have tax, whatever tax bracket I'm in. So 100,000, say I'm in the 30% tax bracket at that time. I'm going to have taxes of 30K at ordinary income. Okay. I can also purchase the life insurance. So this is called a swap. So if I have $1 million here with 100K in cash value, and I have 30K over here in just say liquid cash. Remember, I'm in the 30% tax bracket, so I can swap this 30K, oops, I can swap this 30K into the plan, and then this $1 million death benefit comes out of the plan, and now it is tax free. So you have to replace the asset with the taxes it would cost to make it a tax-free asset. Okay, so it depends on their tax bracket. Now, if I died while this was still inside the plan, $1 million minus 100,000, so 900,000 is tax-free. And then I have to pay taxes on the 100,000, so I would get a 30% tax bracket. My beneficiaries would get $970,000. Okay, that's how that would work. Now, the other thing that you could do is the fourth option is a loan strategy. So I have $1 million for $1 million face. I have 100,000 in cash, and I'm in the 30% tax bracket. Well, I take a $30,000 loan, put it up into the policy, and then this comes out. So it's a swap using your own money. You paid the taxes to go back in the taxable account, and then the other 70,000 is tax free. Does that make sense? So there's a lot of options, a lot of ways you can do this. Now the cool thing is when you think about this, when you think about the clientele you're looking at, people who are saying they're getting killed by taxes, they don't know if they can retire, or they want to buy out one of their partners. These are ways you can do it. When would you like to retire? That's a big question. Are they saving? Probably not. Are you looking for another tax deduction? If I could show you a way to get more tax deductions, help you save better for retirement, and if employee retention matters, would you be interested? Those are your questions. Here's a good example of another one. This was a side hustle. So a pro athlete, so NBA pro athletes, they get a 401k. Outside of that, he had a side hustle. He actually had a shoe deal. His focuses were wealth transfer and employee focus. Why? Because he put his father and mother on payroll. He has a former teammate who's also employed, and he wants to put $1 million away to get some tax deductions. So what do? They put him on payroll. So this 412(e)(3) plan, you've got $375,000 on dad, 415,000 on mom. Then you got the employee up here a little bit, and 110 on the athlete. So now he has $1 million deduction. And guess who the life insurance proceeds for these two policies are going to go to? Deductions, death benefit. Mom and dad are happy. Now they have a guaranteed income for retirement. Gets them out of his pocket. So you can see there's different things that you can do here. You can even think about doing buy sells. So when you talk about buy sells, they each need 2 million of insurance here, three partners, no plan in place. So can qualified life insurance help? Absolutely. So you do a 412(e)(3) with max life insurance. You have opportunities with, the employees have to be a part of it too. But then, like I said before, you have the ability to turn those into tax-free. So one of the business owner leaves, you gift it to them, they pay the tax on the cash, and they walk away with the life insurance policy, tax-free retirement strategy, whatever you want to say, and then the other two owners are left. So you can even do this thinking non-traditionally, buy-sell agreements. People have always asked me, Phil, can I get a tax deduction on a buy-sell agreement? My answer was always no. Why? Because an S corp and an LLC and proprietorships are all straight line through to your personal taxes, so there's no deductions. But if you set up a plan like this, now you have deductions. Kind of at the top of the hour. So I'll ask any questions. Does this make sense? Most important thing about this. Go ahead, Rick.
No, it's perfect. The biggest thing is, the business has got to be really profitable. That's, I think, the whole key, right? Is the tax deduction. You got to look at that. So don't go to somebody that's just barely making a profit. It's not going to work. So it's a niche program, but it's a great program for the right
Yep.
fit.
At least 5 years of funding. If they can do at least 5 years, we're good. They can dissolve the plan after 5 years, but you want to make sure that they are profitable. They're able to continue the premiums. So yeah, you make a great point with that, Richard. Rick.
Does that applies for the 401Ks also?
401Ks you can't really do a buy sell agreement with. That's straight up just raw investing inside of a plan. This is using the 412(e)(3) plans, which integrate life insurance into the the plan for tax deductions. So think the upside down wedding cake, the 401k is down here, 412(e)(3) is the biggest part. It's got the most frosting.
Got it.
Yep,
Thanks.
no problem.
Bill, are the
Chris?
business owners able to access the cash value and like the whole life piece while the plan's still in force?
Yep, you can take loans against it as well.
Got it.
So yeah, just make sure you don't mess it up. So, but yeah, it's just treated like a normal life insurance policy at that point. So yeah, you can do that. Business owners can use it as an asset. I'm going to build a west wing on Reshco. So now I need to borrow against it. Would I rather borrow against tax-free money that will get, bank on yourself because it's whole life? So, all that interest is going back into it. Or would I go to a bank and pay them the interest? So it just starts to add up all the different value propositions you can bring to the table with something like this.
Got it. Yeah, that orthodontist I was telling you about, that was one of his things, wanting to use the cash for dental equipment and whatnot.
Absolutely. It'd be highly advisable to put the money back in, but borrow against that versus notes or credit cards or things like that for sure. Unless he really wants
Right.
the air miles. So,
Right.
yep. But yeah, these are the strategies that'll take you to that next level. So, like, I encourage everybody who's here today or watching on the YouTube after I post this is one client. Try one client a year. I like to stretch. I say four clients a year, so get one per quarter. You start having the conversations, and I can guarantee you, actually, that's a bad word to say. I will assure you that you can get 50K added to your bottom line with a solid plan. So if you think four plans, so 200K is 200 to 500K extra per year worth these type of conversations. I'm not saying just go whale hunting, okay? Keep doing what you're doing, but you have to raise the ear when something like this comes up and say, I got something for you. Do you want to set up a time with a guy who is monotone? So I apologize in advance, but he's a specialist that works with business owners to get them large tax deductions and opportunities. And we can go through this. I was planning on making like a client presentation. Aziz, I know that's what you're looking for in Chicago. So yeah, that's the next step.
Yes.
But in any event, I've hit 4 extra minutes. I am so sorry. I can get long in the tooth, but I want to say thank you guys for sticking with me. Again, this will be posted on the YouTube channel, so if you want to review it again, take a gander at this goose. But I appreciate you guys. A lot of stuff going on here. I will do one last thing, and I will share with you guys one last thing is next week, just to give you a teaser, and I said I was going to let you go, and here I am just talking again. Um, I want to share the updated, I call it spider web of opportunity. Okay. So we've expanded on a few things here. Namely, so we have our life insurance side. We still do some alternative investments. Health side, if you are unaware of things like ICRA plans, we have a specialist who can help with ICRA plans that is very, very advantageous for business owners as well. So if you want to integrate in on the health side, we do have very healthy health contracts, and the more you sell, the more you make. We have increased our value proposition now. I have passed my 65 and I am working on my advisory. So I will have an RIA set up probably within the next month or two. So those who are interested in doing assets under management, you have to pass your 65 first. But once you do that, then we can talk about adding advisory or assets under management. And last but
How
not
hard is that
least,
65?
yeah, 65. It's a toughie. It's a toughie,
Good.
but well worth it in my opinion. And Rick, who you've heard a couple times already, is going to head up our commercial PNC division. So if you are working specifically with commercial, we are now able to offer property and casualty from that standpoint, and we will have a business partner come in next week. So we'll have normal 4 to 5, 4:30 to 5. Our business partner from Smart Choice is going to come in. Her name is Krista, and she's going to share some of the things to look out for. And yes, there are opportunities from a partnership standpoint here too. So all things being said, we are expanding, and you see here we now have one, two, three, four, five-legged stool versus a three-legged stool, and all the other ancillary stuff as well. So we're going to continue expanding and growing. I want this to be a one-stop shop for you guys to build where you want to and grow. So just appreciative of the opportunity to serve, and we'll just keep rocking and rolling. So thank you guys again for staying just that little extra minute. I hope you have a great rest of your day. If we don't talk, have a great weekend, great President's Day, and we'll talk soon. All right.
Thanks, Phil.
All right.
Thanks,
Thanks,
See you
Phil.
Phil.
guys. Take
All right.
care.
See ya.